Most investors assume that the bigger the property, the more cash you need to get in. A single family rental might require 20%. A small multifamily might require 25%. So an apartment building must require even more. That assumption is wrong, and it is costing investors years of portfolio growth. There is a CMHC program that, for the right project, can bring your financing up to 95% of the property value. That means you're putting in 5 cents for every dollar of real estate you control. The question is not whether this exists. The question is whether you understand how to access it. In this video, I want to show you exactly how CMHC MLI Select works and why investors and developers who understand this program are building portfolios that most conventional investors cannot replicate. In the next few minutes, I'm going to break down what MLI Select actually is, how the point system determines your financing level, and what a current Alberta project looks like when it is specifically designed to maximize these benefits. By the end, you will understand why the financing structure on an apartment building is not just a detail. It is the entire reason the deal works. If you're new here, I'm Darren from DK Wealth and Growth, and if you've been following along, you know we focus on disciplined CMHC eligible multifamily investing, especially in Alberta markets like Edmonton and Calgary. Stay with me until the end because I'm going to walk through a real Alberta project that was structured specifically around MLI Select and show you what the cash-in requirement looks like compared to what conventional financing would have required. The difference changes the entire math of the deal. Let's start with the basics because there's a lot of confusion around this program. CMHC MLI Select is a government-backed mortgage insurance program designed to incentivize the construction and preservation of rental housing in Canada. It is not a grant, it is not a subsidy, it is a financing structure that rewards projects meeting specific social and environmental criteria with better loan terms than the market would otherwise offer. The program has 3 pillars: affordability, accessibility, and energy efficiency. A project earns points in each category based on how well it meets those criteria. The total points determine the financing tier the project qualifies for. Here is why that matters. More points means higher loan to value, longer amortization, and a lower insured interest rate. All 3 of those factors directly reduce the cash required to close and improve the monthly cash flow from day one. This is where most investors get lost, so let me make it straightforward. The MLI Select point system scores a project across those 3 pillars. Affordability points come from committing to rent, percentage of units below market rate. Accessibility points come from building units that meet accessibility standards, wider doorways, step-free access, and similar features. Energy efficiency points come from building to a higher energy performance, standard than the building code requires. A project that scores 50 points qualifies for a standard insured tier. A project that scores 100 points qualifies for a higher tier. A project that scores 200 points, the maximum, can qualify for up to 95% loan-to-value financing with a 50-year amortization. That is not a theoretical ceiling. That is a real financing outcome for projects that are designed to hit it. The key insight here is that developers who understand this program do not design a building and then check whether it qualifies. They design the building around the point targets from the beginning. That is the difference between accessing 95% financing and leaving it on the table. Let me show you what this actually means for an investor. Take a $10 million apartment building. At conventional financing, say 75% loan to value. You need $2.5 million in equity to close. That is a significant capital commitment, and it limits how many deals you can do before you run out of deployable cash. Now run the same building through CMHC MLI Select at 95% financing. Your equity requirement drops to $500,000. You are controlling the same $10 million asset with $2 million, less capital tied up in a single deal. That $2 million does not disappear. It stays available for the next deal or the one after that. This is why serious multifamily investors are not just looking for good deals. They are looking for deals that qualify for the best financing structure available. Because the financing structure determines how fast you can scale, not just whether the first deal works. Quick question for you. When you think about getting into multifamily, is the down payment the biggest barrier, or is it something else? Financing, deal flow, confidence in the numbers? Drop it in the comments. I read through them and it genuinely helps me understand what to break down in future videos. Let me show you what this looks like on a real project. We are currently looking at an Alberta multifamily project that was designed from the ground up to qualify for CMHC MLI Select. The developer built the affordability, accessibility, and energy efficiency criteria into the project before a single unit was leased. Because of that, the project qualifies for high loan-to-value CMHC insured financing with a 50-year amortization and a lower insured interest rate than conventional debt would carry. The result is a deal where the cash-in requirement is a fraction of what you would need on a conventionally financed building of the same size. The debt service is lower because of the longer amortization and the insured rate, and the cash flow is positive from day one, not because the rents are unusually high, but because the financing structure is doing the work that most investors assume only a great deal can do. This is what it looks like when the program is used correctly. The building is not just an asset, it is a financing vehicle, and the investor who understands that has a structural advantage over every buyer who is still thinking in conventional terms. Here is the real point. Most investors think the path to scaling. A multifamily portfolio is finding better deals, and deal quality matters, but the investors who scale fastest are not always the ones with access to the best properties. They are the ones with access to the best financing structures. CMHC MLI Select is not a loophole. It is a policy tool that the government designed specifically to encourage this kind of investment. The program exists. The financing is real. The question is whether you're working with people who know how to access it, or whether you are still approaching apartment buildings the same way you approach a single family rental. The structure is the advantage, and right now, most investors are not using it. If this kind of disciplined approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC eligible opportunities, financing structures, and real portfolio growth strategies before capital gets committed. And if you have a question you want me to cover, drop it in the comments. I read through them. If you want to see the latest MLI Select eligible opportunities we are currently reviewing, click the link below to request access. Thanks for watching, and I'll see you in the next video.